Get ready to dive into the world of economics in 2024, where things might slow down a bit, but a full-blown recession seems less likely. Previously, there was talk of a small recession starting in late 2023 or early 2024, but now the forecast has changed. Let's find out why and take a peek into what the future might hold for the economy. Understanding the way money moves in the big picture, like how much people spend, how much gets produced, and how many jobs are available, usually takes about a year to catch up when there's a change in the way the government handles money. But as we'll see, these changes can take longer or shorter, and every time is a bit different. There's no one-size-fits-all approach to these economic cycles. Let's break down why this slowdown is taking longer than expected. We'll look at 4 things that explain why the effects of the government tightening its control over money are delayed. First, when interest rates go up, people usually buy fewer cars, which leads to fewer cars being made. However, this time we had a backlog of people wanting new cars because of past problems with making and delivering them. In 2023, more cars became available and prices even dropped a bit. But now that the demand for cars has mostly been met, expect sales to decrease in 2024, especially with a mismatch between how many electric vehicles are made and how many people want to buy them. The second delay comes from businesses spending less money when the government tightens its control. Some of this decrease happens because it costs more to borrow money, and some is because businesses aren't as hopeful about the future. In this case, though, companies had already ordered computers and equipment to make up for a shortage of workers. The third delay has to do with the job market being competitive. Some people who lost their jobs found new ones quickly, while others took a bit longer. This situation delayed a decrease in how much people spend. Let's take a look at what's happening right now in December 2023. The economy is still growing and the signs are mostly positive. While no measure is perfect, combining several can help us predict what might happen in the future. For example, when short-term interest rates are higher than long-term rates. It's called a yield curve inversion. This is a strong signal that things might not be going well. Unemployment insurance claims have been steady for the past 2 years, suggesting that jobs are still available. The stock market, which usually goes down before a recession, is actually looking better lately. Despite these positive indicators, we should expect a bit of a slowdown in 2024. The increase in interest rates and less money circulating in the past 2 years will likely slow down economic growth. Jobs might be a bit harder to find, but not too much. Prices will probably keep going up, but not too fast. Now, there are some risks on the horizon, especially concerning global politics. Conflicts in Israel, Chinese pressure on Taiwan, and potential support for Guyana against Venezuela could pose challenges. At home, overspending by the government could also cause financial issues. People might start getting worried and hold on to their money, and companies might become less optimistic about investing in new things. Remember, just because some economists thought there would be a recession, and it hasn't happened yet, doesn't mean it won't ever happen. It's always a good idea to be prepared for different economic scenarios. Looking back at 2023, the world economy had some surprises. Despite interest rates going up, the US managed to avoid a recession. Major emerging markets didn't face a debt crisis, and even Japan's economy showed unexpected vitality. On the flip side, the EU fell behind as China's rapid growth slowed down after 4 decades. Now, as we peek into 2024, there are big questions ahead. What will happen to long-term interest rates? Can China avoid a major slowdown with issues in its real estate sector and high government debt? Will the Bank of Japan adjust interest rates smoothly? And could the effects of the Federal Reserve's interest rate changes lead the US into a recession? Emerging markets face their own challenges, and what could be the next major global issue? A Chinese blockade of Taiwan, the US presidential election, or something unexpected? These questions are all connected, and we have to consider factors like high debt, changes in global connections, increasing populism, the need for more defense spending, and the shift towards green initiatives. These factors might keep interest rates higher than usual for the next 10 years. China, in its efforts to boost economic growth, faces hurdles like stifling entrepreneurship and a high debt-to-GDP ratio. Their plan seems to be spreading support across provinces and limiting new borrowing by local governments. However, balancing this while shifting to green energy and electric vehicles poses challenges. While Japan had a strong economic year, the International Monetary Fund predicts a slower 2024. How Japan handles the transition from ultra-low interest rates becomes crucial for a smooth landing. Even though the US economy didn't fall into a recession in 2023 as many thought, there's still about a 30% chance of it happening in 2024. President Joe Biden's administration continues with an active fiscal policy, even with the economy doing well. The possibility of inflation, along with a divided Congress in an election year, could impact spending. Some countries even benefited from geopolitical tensions, like India securing discounted Russian oil during the war in Ukraine. As tensions rise globally and polls hint at Trump's favorability in the US election, 2024 looks set to be a challenging year. Our sincere wish is for everyone to successfully navigate through this challenging period and emerge on the other side of the tunnel stronger and more resilient. Thank you for making it this far, and as always, stay blessed.